Get started for another epic episode of Untold Stories. What is up, everyone? I am Charlie Shrem, and you are listening and watching Untold Stories, where twice a week we get to dive deep with some of Bitcoin, crypto, Web3, just really all influential leaders, all brilliant people, those who have turned trauma into success, those who have built crazy businesses, those who are reinventing finance or reinventing any industry using crypto and blockchain rails, talking about Bitcoin being the soundest money in the world. And here today, and when we understand how this whole movement came to be, we can understand where we are right now in the larger scheme of things, where we are right going. I just read a crazy statistic this morning that Bitcoin adoption is at the same place that the internet adoption was in 1995, but it's going twice as fast. So by 2000 by in 4 years we're going to be at the same type of adoption that we had on the internet as 2005. Bitcoin will have reached a billion people. So imagine how that's going to completely affect the larger crypto markets and all the industries and DeFi and NFTs and all the industries that operate in and around it. And here today to talk about some of the credit and capital markets, Milo Credit, Josip Rupena. Thank you so much for coming on Untold Stories today.
Yeah, absolutely. Pleasure to be here. Thanks for having me on the show.
You're the founder and CEO of Milo Credit, a financial technology company that offers home loans to global and crypto consumers. So before you started working with Bitcoin, you were offering mortgages and home loans to, I would say, like di- somewhat disenfranchised people, like those who are foreigners or those who have a lot of assets but don't earn much income anymore because they live off their assets, and they do all types of businesses that way. They invest in different assets. You know, they always say invest in assets, not liabilities. Most people, to be able to continue growing your empire and your wealth, you're not really making a paycheck every day. You're building off your current assets. But really, the only way to get a mortgage from your local bank or any type of loan is you need to have that like really large paycheck. There are no other ways. So you've invented like a whole new risk method and a whole different mechanism for doing loans. And now you do crypto mortgages, and you're offering amazing rates for. You've worked with folks from 63 different countries, and so there's a lot of different topics that we could talk about today. Prior to running Milo Credit, you worked at Goldman Sachs. You were a portfolio manager and head trader at another investment firm that had $1 billion under assets. You worked at financial advisor at Morgan Stanley for working for international clients. So there's a lot of like the macro world is going right now. But we were talking something very interesting. I think today or tomorrow, the Federal Reserve is going to hike interest rates. The whole world has been like on pins and needles. The crypto markets has been like Bitcoin has been in the tightest range it's ever been in. There's a Russia Ukraine war. Commodities are going crazy. Nickel markets are having to be shut down. But you pointed something out to me prior is that in 2018, the rates were in fact higher than they are now. And we were in crazy bull markets. Everyone was making money. Everything was doing really well. Economy was strong. So why, first of all, thank you for coming on the show. Did I miss anything about your intro? And why do you think people are worried now when the economy is in fact stronger than it was in 2018?
Yeah, absolutely. I mean, I think that there's a lot of sort of great points in there. I would sort of add that sort of that statistic of 63 countries, it's actually closer to 90 plus countries where people have applied now.
Oh,
And
wow.
it was really sort of rooted in our business, and sort of why I started Milo was to be able to help customers that I felt were really great consumers, but the existing sort of financial system wasn't really designed for them. And really sort of this aspect that the world is changing in the way that people are choosing to invest their wealth, where they're allocating it, specifically into crypto, is something that I see as a broader trend that over time, more and more people will continue to create wealth. And it's important for companies to come up with unique solutions for them to be able to account for that. And that the financial system that was built over the last 100 years is probably not the same of how it's going to look for the next 100 years. And companies need to basically adapt to that.
How can they adapt to that?
I think it really comes down to just thinking about um, from a consumer perspective, what are the technologies that are out there today that didn't exist, 5 years ago, or specifically, right, sort of Bitcoin didn't exist, 13 years ago. That aspect of being able to, start with the fundamental premise of saying, is this a good consumer? Does this consumer have the ability to pay? And if so, how do we get comfortable underwriting this consumer and ultimately delivering, what are very, very good assets to people that, sort of deserve credit. So I think it's somewhat, starting from the foundation and sort of building upon sort of this new foundation, as opposed to trying to take the old chassis and having to change that, because it's very, very hard to change the existing system.
It all seems like it all relies on like risk and hedging your risk and having different middlemen who take a position on that risk. There's future markets. I mean, you could put loans into baskets. We saw that in 2008, 2009. So you guys have
Yep.
been reinventing this whole industry, and congratulations on your $17 million raise, by the way.
Oh, yeah. Thank you. Yeah, that's a big milestone for us as a company and the team, to be able to continue to go on this path and sort of, broaden our mission and sort of our purpose to be able to help more and more consumers. And I think the really exciting part for us, the previous month, was announcing this sort of first 30-year crypto mortgage, to be able to be part of that wave that I just described, and sort of helping more consumers. So that 17 million is a big part of that for us to be able to do that.
It's taking a huge faith in the future of Bitcoin too, because you're offering these very, very long term. I mean, it's the over the course of most of a person's life. So you're able to collateralize this new asset that's like 10 years old, in and turning that into like wealth creation for people. It's like I can't think of any other bearer asset that could ever be used as like collateralizing a loan, that where you have the rates this low, like a baseball card. Like what else would you do?
Yeah, I think that's the beauty of sort of being able to combine collateral, right, with sort of Bitcoin and crypto, with the combination of real estate, and saying, well, how do you mitigate some of that risk, where you have real estate which is fairly illiquid but has value. I think that today, if you had a home, people would assume it is fairly liquid since there's so much demand to buy homes out there. But being able to combine that asset with crypto that is liquid, that you can, possibly, liquidate to make payments in the event of some stress. I think it just becomes a better structure, because it's much more in line with how people think about their wealth. Right? They don't think about it. People like to be able to have liquidity. They like to be able to, swap in and out of things. They like to be able to sell. They like to be able to have some marketability around their assets. So I think that this definitely sort of combines the best of both worlds.
You brought up an interesting fact about homes, and I kind of want to, maybe you have a good insight for us. Is that especially it started in 2019, the end of 2019, early 2020 when COVID hit, but something changed. You and I have lived through the crazy financial crisis, the housing market crisis of 2008,
Yeah.
2007, whatever. So
Yeah.
we're always like nervous. But before that, housing was relatively stable for decades, right? But and how are we looking, and why are homes so in demand right now? Is it that we didn't build enough? Is it that we can work remotely from our homes now, so the home is now more of like a sanctuary, a place you can work, or a home base? And were we not going in that direction prior to COVID?
Yeah, I think that if you sort of step back a little bit and sort of you look at historically, what housing has meant, and if you there's always been sort of these cycles, where sort of the desire to buy homes has sort of ebbed and flowed. I think that if you go back to sort of early 2000s, there's a mandate to incentivize homeownership, and sort of in 2003, that allowed the beginning of sort of this bull market in real estate that really sort of pushed into sort of, unfortunately, the financial crisis of sort of 2008, 2009. But it was really driven that people wanted to buy homes, and it became a fantastic asset. And for much of sort of the last 50 years, you've really only had two asset classes to really create wealth, and that was real estate and the equity markets. So you really had those two places to be able to allocate to. And after having sort of the hangover of 2009 with housing, I think it became much more of a dormant asset class. Right? So real estate for the better part of about sort of 8-9 years housing wasn't seen as that asset class where you could actually create wealth. And then things changed, with COVID, specifically with COVID, where you had this alternative where people could essentially buy in the equity markets through sort of 2010 to through 2020. And the beneficiary there, I think, was crypto, because it became this third asset class that you could sort of allocate and really create wealth. But then COVID comes along, and people started to think differently about housing. People started to think differently about wanting to buy homes and sort of diversify, and then sort of changing from just being a renter into actually buying homes. And so there's that shift. And then the other thing that happened was sort of this trend where sort of millennials coming into sort of peak home buying years, and being in a
A lot of
really, really
lot of
strong financial
wins.
position. Yep, lot of sort of macro tailwinds that allowed all this to happen. So having a very, very strong consumer with a lot of savings, coming out of the sort of COVID, where they weren't able to travel, they weren't able to spend, they weren't able to do a lot of these things, and sort of being in a really, really strong financial position, and then rates being at all-time lows, and then on top of that, having a 3 to 4 million home shortage across the country. So these were all sort of really big sort of macro trends that were happening, that really takes us into a really, really tight housing market, that a lot of people started experiencing last year, saying, I want to buy a home. And then we were seeing that for every loan that we did, there was roughly sort of 5 to 7 offers on that home. And then fast forwarding to this year, and for every home that gets sold, there's probably 13 to 15
Yeah.
people who would buy that home almost immediately. So there's not a lot of inventory. Rates are still historically low, and people have wealth to actually afford these homes. So it's a really fascinating time with all of these things happening simultaneously, which is one of the reasons why I think the housing market remains and will probably continue to be strong, for sort of at least sort of short to medium run.
A lot of talk to anyone whose valuation is like doubled of their home, and the first thing they'll say is like, "Where would I go?" And I say that the same
Yeah,
thing too. Where would I go?
yeah.
Is there any value in the rest of the country? Is there any like underserved, or like have you noticing any areas of our country where you can still get a good value of a house?
I think we've definitely seen that people are moving to certain pockets. Um, so we're based in Miami, but we've done loans all across the country, and you definitely are seeing that consumers are moving to other pockets: Orlando, Tampa, the West Coast, Naples, and Florida, and then other cities that are not sort of the main major hubs that you would imagine. Because I think that people do feel that they can get good value there. If you think about where people are moving, you definitely saw that shift to Florida, Texas, and some other sort of Sun Belt markets from the Northeast,
Yeah,
and I think that there's good value there.
it's almost like what's going on in the past 2 years is almost like a mass human migration, because if you look at the over at Europe too, people are moving towards freer states, of course, and things like that, but they're moving towards like better weather. Like that's the elephant
But
in the room here. They're going towards places that are friendly but also have better weather. And I think it's a
but
mixture of like climate change is getting worse. And so the places in the north where it's just going to get colder, combine that with the crazy politics of the northern states that had these crazy lockdowns. And it wasn't that lockdowns were bad, it was that for a lot of these places, it was like one or two people in a room saying, "Let's shut down the economy, let's lock everything down." And there was no like, "Hey, let's have a conversation about this." And people were like, "Shoot, I'm in my house and I'm locked down for the next year or two." We saw that all over Europe, and people are migrating away from it. They're saying, "If I'm going to be locked down, at least let me be locked down in a warmer place that I can be outside," because that seemed like it was the best thing to do.
for sure, and I think it COVID gave people the opportunity to try something new, right? To go to Florida, to go to other places, and to spend some meaningful amount of time there, not just a weekend, right, or a week or a short vacation. And then once they sort of settled in, they said, this is pretty nice. Let's see if we can make this work for a little longer period. And I think that's what's prompted people to move. And quite frankly, I think that migration is real. I think a lot of people that have moved to some of these hubs, warmer weather, better quality of life, better balance. They're unlikely to go back to some of those other markets, especially if they have the
Yeah.
flexibility to continue to work from there.
So on one aspect, it seems like getting a mortgage, getting a home equity line of credit, doing financial moves with your properties to get more properties, or the relationship between you've always been able to get loans like against your stocks, and so now this just solidifies Bitcoin as the same type of asset class. But it's still like a fairly private thing. And that's, I think, from the consumer end. You want your financial relationship to be private. You don't want to let everyone know what you're doing. But I do see some of these projects like the Bacon Protocol, that's like securitizing homes and very quickly securitizing homes and then putting them on the blockchain, fractionalizing them into like NFTs and then passing kind of the interest. Do you think we're gonna go there, or will that stay a niche market, a niche
Yeah,
product?
that's a great question, and it's one that I think a lot about. Sort of where where is there an opportunity to possibly change the way that things have been done? So, for example, in this country, the majority of mortgages are really subsidized by the government, by sort of the agency, sort of Fannie and Freddie, and that was really something that was started, you know, a long time ago, right? Sort of in the 50s, and it was sort of a reaction to being able to sort of stabilize housing and being able to incentivize primary homeownership. And with that, it allowed more people to be able to access home credit. It allowed people to basically get 30-year mortgages, but it was really built on what the government was doing. And today, there's over $10 trillion of mortgages that are out there. Trillions of dollars of mortgages get originated every single year because of that methodology of um, being an originator, where someone makes a mortgage, it's underwritten to the standards that are acceptable to the agencies, for risk, for income levels, and all these sort of these qualifying criteria sets that allows the loan buyer, which in this case is the government, to be very comfortable with underwriting this loan. And that system works, but it's very, very rigid. Meaning you're either going to be able to qualify for that loan or you're not. And I think that as you think about it, things like crypto don't necessarily fit nicely into that box.
Yeah.
And so now, there's this opportunity to really think about, well, what else could there be if you don't originate a loan and you don't sell it to the government? Well, what happens there? And there's a sort of private credit, private mortgage market that's out there where people are comfortable thinking about different qualifying criteria, but the rates are higher, right? There's different risk, and you don't have that government subsidy to be able to get that really, really low rate, but it is an opportunity. And then I think that there is this universe where possibly some of that does migrate into crypto, and you're able to leverage other aspects as well to create this third, potential mortgage market
Wow.
out there that could develop. Um, I think that with that, you're going to have the absence of potentially that government, that U.S. government subsidy, but it could be the beginning of this new capital market structure, which Milo as a company is definitely going to be sort of exploring to see how do we expand credit to more consumers over time. But at that third category is the one that's really fascinating to me.
Yeah, it's really cool to see, and it's like there's so many a lot of the risk comes down to the underwriting, and I didn't realize like what percent of mortgages out there are subsidized by the government, and what does that actually mean?
So what that means, and I'll say that it's the majority of the market, right? The because there, if you think about when you issue debt, there's ultimately someone who wants to hold that debt, and they're going to determine what is an acceptable level of interest that they need to earn for that, for lending out their capital, right? The fixed income bond market. And what ends up happening is that if I decide to lend to someone and maybe I'm comfortable lending to them at 10%, just hypothetically, right? Where I think that there's a probability of default there, or that they won't pay me, and depending whether it's secured credit, right, by housing, or unsecured credit like a credit card or an auto, or some type of personal line of credit. Um, what will end up happening is that what the government has done with the agencies is they've come in and they've stepped in and said, we will take potentially some of that loss. So now you as an investor, if you're covered from that loss, you're likely to accept a lower level of interest rate because you have less
Yeah.
risk in that aspect. So that's essentially what the government has done, is that they are the backstop for a lot of what happens in the mortgage market. So that's that subsidy that I'm talking about that allows institutions, right, very, very large governments to buy, Fannie and Freddie backed mortgage bonds, governments around the world, endowments, sovereign wealth funds, real, sort of asset managers that have trillions of dollars at their disposal. They're very comfortable doing that, just like they're very comfortable buying a U.S. Treasury security, right, a bond or a bill or some other type of government, U.S.
This is
government
how the
backed
world
note.
goes around.
Exactly. So you have that aspect, and then you say, a treasury yields something, and then now you have a mortgage component, and the rate will be slightly higher, but it's very, very, very tight. So that allows, someone who basically gets out of a loan here to be able to now, borrow money at 4%. I think the twos and threes are gone. But borrow money very, very cheaply. Where if someone was lending someone money for 30 years on their own, right, they would probably be asking a very, very high level of interest. So that subsidy is really what that government provides.
So like a private lending pool wouldn't really want to securitize all their debt and offer it as like a fund for other wealth to invest in because the interest rates are it's too high. I mean, they're charging 10 to 15% or whatever.
Yeah,
Whereas traditionally banks can offer right now at least like 2 to 4% or 3 to 4% or whatever because they're
yeah,
government backed, and then they can access institutional capital. They can borrow for basically for free from the government because they're so big. So you have all these
exactly.
big companies just working with each other, institutions are all just trading with each other, offering the American housing market as like an ETF style fund to the rest of the world, dollar denominated. But what you can do now, Milo Credit can do, is because all the middlemen are you. You are everything,
Yep.
and you have all these homes that are locked up now. You have the liens against you as a startup. I wouldn't even say you're a startup anymore. Could launch the same type of institutional fund, but because your rates are like maybe even half of what a private lending would require, that's an attractive fund to potentially invest in. You could NFT that. That's like a, and then because of these loans are like Bitcoin backed, it's like double win. I'm now investing in the American housing market, but I'm also investing in some Bitcoin too.
Absolutely, absolutely.
That's
And
a
I think
great
that
idea.
that's that opportunity to really find a good consumer that I think that the established sort of system isn't really recognizing or sort of underwriting, I think, or adding the right, sort of risk metric to, and then sort of pulling that all together and saying there's an opportunity here in what is a very, very large asset class, which is the real estate market. The real estate market, sort of in the U.S. is over 35 trillion. It's a massive space, and one of the reasons why I think we have a really big opportunity here to innovate and possibly change the way that things have been done and expand credit. I will, however, say that for a majority of the people that are in this country, right, they are able to sort of get these mortgages. But I don't think anybody has ever said, "Hey, I had a fantastic mortgage experience. Let's do that again." Right.
Yeah,
So
true story. I
there's a big
guess you're
opportunity
right.
there. Right? So, yeah.
Do you so Bitcoin, would it make your job easier if there was a mechanism within Bitcoin code itself that allowed you to custody it where there was no risk other than Bitcoin code breaking or blockchain? Like right now you have to probably pay a custody provider to
Yep.
maintain that, and that goes into the cost. Would you
Yep.
like to see, because there are Bitcoin developers listening, would you like to see something like that? Would that change how you price risk?
Yeah, I think absolutely. I mean, I think that there's that element of understanding once you have collateral, right? I think that the part of, for example, real estate, real estate as an asset class, um, the way that your lien is perfected is that that's recorded with counties, and in that county, there's a lien that everybody that looks at that property when you run a title search, whether there's a debt or something or a claim on that asset, and it allows to basically allow a lender to get comfortable with deciding to extend credit to that person. And I think that if there is an opportunity to do something similar like that, then that would be tremendously valuable because now someone else would know that there is some type of claim on that asset,
Yeah.
and would definitely sort of facilitate a transaction to you be quicker and possibly even in real time to extend credit, and obviously that opens up a wealth of opportunities to be able to extend credit to more people and really think about even duration, right? How long do you extend credit to someone, right? Someone may not want something that is a year or 20 years or 30 years, right? They might want
Oh
something
yeah.
that's shorter.
It also varies by state too, right? All states have different property laws, and like Florida has a quick deed. You can take over the property in 30 days or something, whereas like
Yeah.
New York, it takes, oh my God, I'm in that process, like 2 years because we loaned someone
Absolutely.
money up there. So it's like, what's like, is there a worse state than New York State for like property rights and stuff like that? I
Yeah,
wonder
I think
if,
absolutely. I mean, yes. Sorry, I think I lost you for a second. I think that's one of the things around mortgage is that there's a ton of regulation, and with that regulation, it really is on a state by state basis. And so everybody has sort of different ways of recording loans. It has different ways of sort of interpreting laws, and that's what makes the mortgage market very, very interesting. And quite honestly, right, that creates a lot of the complexity there because you can't really
yeah.
standardize it.
So these rates that, we're talking the Federal Reserve raising these rates, it doesn't just affect home prices, it affects your credit card rate, it affects your auto finance rate, it reflects all different types of rates. Um, is there like a number that if inflation and or these interest rates rise too much that people won't be able to afford to like service their debt anymore?
Think that where rates are today, I think that they're still at sort of historical all time lows.
So low.
If you think
Yeah.
about where rates have been over the last 50 years, we're on the lowest side of that. I think that when you run the math and you say rates have moved roughly about 1% over the last sort of 45 to 60 days higher. Um, Rates in 2018 were higher as well, right? The Fed was raising rates at that point in time. We had multiple rate hikes, and then we ran into COVID, and then there was this adjustment to reduce rates. But that didn't stunt the housing market because a lot of the reasons of why people are buying housing are driven around sort of their personal situation of where they are in their life. If you think about the housing market in 2005, 2006, most people were getting mortgages at 7 and 8% interest rates, and many even higher than that.
Oh yeah, I
So if you think
remember.
about it today and say someone getting a 4 or 5% interest rate, it's still attractive, right? From that perspective. So I think we do have some room where rates could move pretty significantly to the upside and it not really impact housing that much so because of all of these other sort of macro events that are happening out there where if your rate goes up 1% and maybe now your mortgage payment goes up $200 or $300 depending on the amount of the loan that you're getting. Is that material enough for people to decide not to buy a home? I would say that for the majority of people, that's not the determining factor to not buy a home. I'll add to that, the other thing that we've been seeing is that rents have been rising
Yeah, they
rapidly
have.
across the country. I think that we've seen that for our team members all across the country, their rates have gone up. Their rental rates have gone up pretty significantly. So right now we're in this really interesting place where if you think about sort of your housing cost, because your rents have rise so much and your mortgage costs are still would be lower than that, there's this opportunity where even if your mortgage is higher, you're probably still going to be less than if you're paying rent. And so there's that slack where for a long period of time, it was more economic, it was beneficially to you to rent as opposed to buying. Now that has inverted. And that's why I think a lot of reasons why a lot of people are considering buying as opposed to continuing to rent because they would own and they would actually pay less a month from a housing expense perspective.
We have this like very robust credit and capital market institutional world here in the US. We have real estate as a function as a function of that, it's part of the retail and institutional like cycle of funds that everyone, so it's all very connected, it all works, and that enables for as long as like America exists, the economy over a long term, dollar exists, there's 500 million people living here, we're all working together, home prices continue to rise, it's just a function of the economy, it's a function of economics. But I read somewhere that real estate is not like this in the rest of the world. Like I have to look up the details, but apparently in Japan, over time, home prices, they go down to zero. It's like they depreciate like a used car. And I'm like, can't figure out why. And I'm trying to understand if it's because people there just don't sell their houses ever. Like older folks just leave it to their kids, or people just aren't buying homes as I don't know what's going on there. I'm gonna Google this.
Yeah, I think that was an observation for us around working with international clients and them buying real estate in the U.S. is that aspect that um, uh, we have uh, our mortgage markets are different, right? A lot of places don't even have mortgage markets, right? The way that we are able to do a 30-year mortgage because of that government involvement. Other countries may have a 1-year loan or a 2-year loan. Other countries also have different mechanisms around how they're able to depreciate those assets as well, right? From a tax structure that changes some of the incentives around holding homes and what that drives.
Yeah.
I think that our market is very very unique, and the system has allowed it to basically grow because of some of these mechanisms that were instituted in our markets.
So you're opening up more the relationship between capital and your home is is getting closer. So now it's always been buying your first home I remember like my parents telling me like, "Oh, your home is not a good investment asset. You're not going to make money in your home. You're going to lose money over the long term or whatever, investment properties." But it's different now because you can work to build equity in your home and then use that to fractionalize a piece of it, get a home equity line of credit, which traditionally was very difficult to do. But now you can
Mhm.
do it at almost the click of a switch, and it could be based on you can have your Bitcoin as collateral that could be there. So now people are using that uh, to like further their own wealth and to build up their empires. You weren't able to do that. I mean, the technology and the software, and even like people trusting a website to do that is so new. I mean, even so, Rocket Mortgage didn't exist until like 2016, I think, right? Or 2015.
Yep. Yeah. It was 2016, so it was quick and before that.
And that process was so difficult to do. And so this is complete. I think you're right. I think it's a lot of headwinds, a lot of tailwinds. So tell me about your product. Like a lot of folks are listening. Everyone on the show has crypto, has Bitcoin. Uh, but they've seen on all these other places to collateralize to get short-term loans, the interest rates are very high, 10% plus. It's really not worth it for anyone. Why is getting a
Yeah,
Bitcoin mortgage different, and how are the rates lower?
yeah, yeah, yeah. That's a great question, and it was something that we thought about for a while, right? And I had been in 2017, even before I started Milo. I had this idea around crypto and what it would mean for individuals, and I felt that it would be this opportunity where wealth creation would happen, and that at some point in time, um, as people were amassing this crypto wealth, they would want to do something with that wealth. And I felt that the opportunity was around buying real world assets, and sort of buying homes and buying sort of other assets. And interestingly enough, I thought art would be one of those asset classes, and sort of NFTs came around. Uh, but I did feel that people would want to do that, and that would become a more important component. But I did feel that 2017 we were too early. We were too early in that sense that as an asset class, crypto as a whole was roughly sort of 400 billion, and we weren't there yet. And sort of fast forward, at that time, I was calling for the asset class to be roughly 3 trillion by 2022, and we got to that level last year, and sort of seeing what was happening and that there was a lot more wealth out there, and we started asking our consumers, what do you have crypto? You know, how do you think about your crypto? And everybody was sort of talking about it as this was a long term asset for them, and it was sort of this alternative. And we thought about some of these loans that were out there that were short term in nature, and I think that there's a place for them. But I felt that we needed to figure out a way of how do you get longer duration, because buying real estate, for some people, they may flip it on a short term, but the true benefit is holding it for a longer period of time, right through those cycles, to really be able to maximize homeownership. And the beauty of real estate is that you're able to get leverage on it. You're able to borrow, right? You're able to put a small amount of money down and benefit from that appreciation, where you don't have to finance 100% of that transaction. So we were looking at this saying, well, how can we
Mm.
combine Bitcoin with the desire to buy real estate and saying, well, this needs to be longer. You can't be doing 6-month loans and 1 year type loans to actually get the desired return right. And that was really sort of what the magic of our product is, sort of getting something that is longer, um, and at the same time thinking about the big motivator, which is how do you continue to keep your Bitcoin through this period of time, and understanding that Bitcoin helps to reduce some of the risk in the transaction, um, because now you can get more comfortable with not just having the real estate there, but having the ability to have Bitcoin as well. So by combining those things, it allows you to really get this really nice solution where you get to keep your Bitcoin, you get to invest in real estate, and ultimately, as a lender, we're able to mitigate some of that risk by combining both of them.
You're also setting up the technology to be somewhat agnostic in just, hey, it needs to be a crypto. And it's my very, very firm belief that anything that can be securitized will be securitized.
Yep,
So I'll
absolutely.
be able to go out and get a verified NFT issued that represents 100% ownership in my house. And then I could potentially take that, deposit it in Milo, and get more credit. You know what I mean? Like anything. You talk about art. I think one of the it's impossible to do it. I've never seen it's impossible to do it now, but I want to be able to securitize everything on my personal balance sheet and be able to use that and get credit based on like the total. So you're talking
Hmm.
about art, crypto, real estate, all sorts of type of assets, even cars, even depreciating assets have a benefit of securitizing on top of a blockchain. And I think that's where you're
Yep.
going to see it's like you're just removing all of these 'cause because you can go out now. Oh my god, I can't even imagine if I called up BMO Harris or something. I was like, "Hey, I have some I have a friend who has like a few $1,000,000 in all these different assets. Can you take it all and basket it all together and issue like a 30% TLV loan?" Oh my god, they're gonna be making crazy percentages and origination fees and everything just for the due diligence, the title searching, the custody, everything. You're building now the mechanism to do that all at the drag and drop, drag and drop.
Yep.
It's beautiful.
Yep.
I mean, that's the future right there.
Yeah, absolutely. Like if you think about, how does credit happen in the U.S., it's primarily driven around a credit score, and actually having that score, which sort of catalogs all of the credit that you've taken out over a period of time, and attributes a number. And so, if you pay your bills on time, then you'll have a higher credit, and you'll have a higher likelihood of being able to qualify. And if you don't, then you'll have a lower score, and you may not be able to qualify for certain aspects of it. I think that in sort of crypto, there's this opportunity to be able to catalog that with your actual assets, and be able to create this alternative credit system to that. And if you're able to sort of create that mechanism to have some type of lien on those assets, then it actually becomes a safer system to be able to extend credit, because you have recourse, and you have the ability to
Yeah.
to to, to essentially offer a solution to someone much quicker. Where in the conventional world, you're really having to rely on this credit score, and you can slice it up any number of ways, but ultimately a lot of it defaults back to how do you mitigate default
Yeah.
in those situations. In this case, you actually would have very sort of perfect collateral that you would actually have a claim, and you could really extend credit a lot faster, because you have that asset already tied to your profile. So I'm really excited around some of the evolution that comes with these alternative credit systems that could be done with crypto to really make the world a lot fairer around being able to offer the right solutions, and really sort of pricing these loans a lot more reasonably, right, from a rate and risk perspective.
Yeah, you're right. You're totally right. You can almost like reinvent a new social credit score system. But in the US we have this FICO credit score system. I want to know your thoughts on it. But how do European banks do loans? Do they have the same type of credit score system?
I mean, I think it depends on the type of loan that they're doing, but a lot of it is definitely sort of driven around the consumer, their profiles, definitely credit scoring. I think that's sort of prevalent in sort of the developed countries, that they do have those mechanisms, and some work better than others. But I think ultimately it's driven around that, and I think that that's the challenge around the world, is that in places where you don't have those systems in place, it's just much harder to get credit, because there's really nothing to fall back on, and then there are varying opinions on how do you extend credit. and the desire to want to extend credit. And you see that, and it's reflected in the interest rates, where the majority of the rates around the world are significantly higher than they are here in the US, if you can even access credit. So I think that that's the opportunity to really create some of these systems, to be able to distribute them into the world, to be able to provide more credit to more people that, out of no fault of their own, they should qualify for credit. It's
Yeah.
just that the system isn't designed for them yet.
What's the cheapest way to borrow money? Like, I've heard that billionaires can borrow money at like
Be a
one.
bank
Yeah,
and
like, so
borrow
what
from
does
the
that
government.
mean? Do you have to have just like a massive stock and financial portfolio that you can go to your bank and they can lend you money at like 1 or 2%? Because I've heard this is true.
Yeah, it is true. So I come from that world, right? Sort of the asset management, wealth management world at Morgan Stanley and Goldman Sachs. And if you had a large account for a client, you could borrow money very, very, very cheaply, because you have those assets, and those assets allow the bank to get comfortable with it. And then there's this element of sort of relationship based lending, right, and relationship based pricing,
Wow.
where the totality of the relationship, where you might subsidize a rate for them because you hope to get more business from them over time that you can potentially monetize in other ways. So there's a value that's attributed to that, and you come up with that aspect, to really give them a great deal on that loan. And I think that that's the part where, for most consumers that don't have those relationships, it's hard to be able to access that, and they have to really sort of step and look at the market that's out there, and really be able to access credit. Or if you don't have those qualifying aspects, you may not be able to access credit. So it's definitely slopes in that way of, having access to certain institutions.
My brother's buying a house right now, actually, and he's like less than 30 days from closing. It's a newly built house. Should he take, well, that's not a financial question, but they're incentivizing him to not shop around his rate and all the closing statement information. The builder wants to do it themselves.
Mhm.
Should people be, a lot of people on the show are probably going through the same type of process. Do you think that
Mhm.
he should be kind of shopping his rate around a little bit?
I think people should think about it in terms of solution, right? I think rate is one consideration. I think that there are other factors that are equally as important,
Ah,
right?
interesting.
Right, sort of that certainty that you can actually get that loan, that you're not going to get to the last minute, and then you're
Rug
not going to be able
pulled.
to qualify for a loan, right? Which happens a lot, right? I think that was one of the things that with us, was really, really important. That, if we tell a customer from the beginning that we're going to be able to do a loan, we do a loan, right? We actually close on that transaction because our technology has allowed us to be able to underwrite the consumer, and we really feel good about doing that transaction, giving them that certainty. So I think that, certainty that the transaction is going to happen is important, right? I think for us, why we wanted to do this crypto mortgage and really launch that is because that desire for people to want to keep their crypto, right? That's a consideration. That element of not selling their crypto is an important consideration. So I would say that, for anybody that's out there buying real estate, you should look at what are the important things for you personally, right? Do you want that certainty? How long do you plan on keeping that property for? Because there's different loans that might actually make sense, in your specific situation. But I think that rate is just one factor to look at.
Really appreciate you taking the time coming on Untold Stories today. Is there somewhere where the listeners can go and get more information about the different products, about the crypto mortgage?
Yeah, absolutely. So they can go onto our website, milocredit.com, as well as on our Twitter account, and then we also have a Discord group where, individuals are able to ask questions, ask for features, and we're talking to the community, and
Oh,
ultimately,
wow.
our product is going to continue to develop, and I want to build the best solution possible. So, I want to listen to what people want, and we'll keep pushing this, because I think that there's a big opportunity to help lots and lots of people.
That's amazing. Congratulations. It's an amazing product. I'm excited to use it and for all the listeners to be able to find out about it and learn more. It's like just solidifies that you're willing to take a risk on us. It further solidifies that we're in the right industry. We're doing the right thing. Because there's still a
Absolutely.
lot of fear in that. It's like, oh, just crypto fat or whatever, but it's not. So
Yeah,
really
absolutely. Yeah,
appreciate
and
you.
that is sort of a big part, where I believe, crypto as an asset class over the next 3, 5, 7 years, 10 years will become a bigger component of people's net worth, and Milo as a company, we want to be part of that solution, right? We want to build things that people can really use. So thank you, Charlie. Appreciate you having me on the show.